Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, especially after such a strong move that has happened the whole of, actually not the whole of last week, but mainly Friday, is that with the markets at all-time highs, what is next? If it's even possible to answer that. But we'll pose that question to our guests for sure. Do select pockets of Indian markets still appear attractive on a valuation basis, or is it all expensive? I think that's an important conversation to have as well. And amongst all that's happening within the semiconductor space, etc., do manufacturing and EMS come firmly into play? I think let's pose those questions amongst many others to Gautam Trivedi. He's co-founder and managing partner at Nepean Capital, joins us right now on the show. Gautam, so good having you. Thanks for taking the time out. I hope all is well. And yeah, this buy the Indian market at every dip just continues, valuation notwithstanding. Is this something that is surprising you as well, or are you kind of the belief that that's how the trajectory will be?
No, I think it's surprising a lot of the people who've been in this market like myself for over 2.5 decades. And the fact is that I think we have the baggage of history, if I can put it that way. We've seen this movie many times before, and sometimes we've seen this not ending very well. So I think what's different this time is the fact that you've got a whole bunch of new investors that are entering the market. I'm referring to the domestic retail investors who were not present in the previous bull markets as much, because a lot of the previous bull markets were led and driven primarily by the FPIs. And again, year to date, FPIs have been net sellers of over $4 billion. So I think this is more of a rally led by domestic investors as the penetration of the equity culture continues into India.
Most certainly. So, Gautam, explain. It's interesting you use the term baggage of history. Is this, and yes, you're right, these reels have played out multiple times in the past, sometimes not ended too favorably. Do you expect a bit of a quote-unquote hard landing in some sense, or do you believe this flow of money kind of helps cushion any kind of sharp blows that Indian markets may take?
That's a very good question. I hope there's no hard landing, because the newer investors who are investors for the first time in the Indian equity markets, I hope they don't have a bad experience. A correction is always good. And the fact is that if they get a correction of 5, maybe even a 10% correction, I'm talking of an average correction, it will, I think, make them wiser, make them more mature, and hope that they continue to invest in the Indian equity markets, because that's something which this country really needs, as we have the need for capital to grow this economy at 8, 9, 10% GDP growth, and to see a prime minister's vision of becoming Viksit Bharat. So I think that equity culture has to come from within. It cannot only come from overseas. So I think there needs to be a correction, no question. Now, if you look at where exactly are the two pockets of pain or potential hazard, one would be the F&O market. Okay, so the F&O market, as we know, 180 odd stocks, and of course the index. So that's one aspect where I think the froth clearly is, because 99% of the daily traded volumes in the Indian stock exchange are F&O. So that's one bubble. The second bubble, of course, is small caps followed by some mid caps. So you've seen that also happening. In fact, interestingly, you brought it up because we ran a screen last week of the top 1,200 stocks in India. 880 stocks, I repeat, 880 stocks, or 73% of the 1,200 stocks are up 36% or more from their respective 52-week lows. And the reason I take a benchmark of 36% because the BSE 500 over the last 12 months is up 36%. So if I take that as a cutoff, 73% of the top 1,200 stocks in India are up 36% or more. Of course, so many of them are up 100%, 200%, 300%. But the point I'm trying to make is that that's where the froth is, and I think that's where the correction needs to come.
Okay. Fair point. So not the whole bucket, but specific pockets which have rallied quite a bit is something that, Gautam, I presume you would be worried about as well. Tell me something, Gautam. There has been this development of this whole new set of sectors that have come to the fore, right? And I'm trying to wonder, and most of them are not necessarily in the Nifty 50 or Nifty 100, but beyond that. mid-cap, largest mid-caps, or small large caps, as the case may be. What has impressed you from there the most? If 2023 was a year of defense that came to the fore in railways, suddenly this whole semiconductor play is coming to the fore as well. What is standing out for you?
I think you make a very valid point. There are certain businesses that didn't even exist 5, 6, 7 years ago that are now getting listed. So, we had only two companies in the EMS space, Dixon and Amber, and of course, PG, Electroplast, maybe three companies. But now we've got about 15 companies that are listed in the EMS space. And I firmly believe that the EMS space is where the Indian IT sector was 25 years ago. Valuations notwithstanding. So I'm not saying they're all buys right now. Point I'm trying to make is the growth that we're seeing in this sector is similar to what we saw with the Indian IT space. And I think the Prime Minister has done a phenomenal job along with his core team of ministers to market India to the outside world and bring semiconductors, bring televisions, mobile phone sets, etc., to get manufactured in India and as an alternative to the China Plus One strategy. So I think that ecosystem that we're seeing is developing. It's in its nascent stage in this country. And I think you'll see the fruits of that over the next 5 to 10 years definitely play out. So I think these are some of the emerging sectors. Again, like I said, they're not necessarily all buys today only because valuations are expensive. But I think from a longer term perspective, if an investor has a 3 to 5 year view, I would certainly start accumulating some of these names.
Okay. And you're not saying you'll probably wait for a better valuation, or do you think high growth will take care of these higher valuations?
The question really is more to do with the fact that is the correction that we spoke about earlier today, is that correction coming? And if that correction is indeed coming, then I think it's better to hold off. And if you get some of these stocks 5-10% lower, that's the best time to build up a position. Again, what I'm saying is true for the whole market. It's not necessarily only for the EMS space, given the fact that, as I said, 73% of the top 1,200 stocks in India have rallied 36% or more. And the list is even more staggering when you look at the stocks that are up 100% or more. So the point I'm trying to make is these are stocks to keep on your radar and on your list of stocks to buy as and when the correction starts to set in, which I hope happens soon for the majority of the market.
Viewers, keep in mind, Gautam Trivedi is not predicting when the correction will happen. He's merely saying that at some point of time the correction should happen, a healthy correction should happen. Gautam, one follow-up. If at one end we have pockets like EMS and some others, at the other end, we have in HDFC Bank, we have maybe a Kotak Bank, etc. It's befuddling some of the best minds of the Indian stock market as to why is it that these stocks are not quite moving. And yes, one of the factors could be the global supply, which has kept them at bay. But then the question comes, when do these stocks, which have been great stocks for so many years, and the growth rates aren't that bad, save for maybe HDFC Bank having these merger-related issues. What's your prognosis on this?
No, I think it's a very valid question with respect to the fact that, for the longest time, you thought private sector banks, were the gold standard, and the PSUs, were really not well run, no skin in the game for the CMDs who were running it, and, lackluster investor appeal. That's, of course, gone 180 degrees as balance sheets got cleaned up. And the fact that, these banks, the PSU banks, became more prudent or seem to have become more prudent in their lending practices. So I think as a result of that, you've seen a gigantic investor sentiment surge towards PSUs and away from privates, HDFC included. So I think that correction in terms of time correction is still happening with the private sector players, including HDFC Bank. I think specific to HDFC Bank, as you asked, there is, I think, a bit of a wait and watch as the merger of the two entities plays out and the impact of that on the balance sheet, as we've seen over the last few quarters, starts to play out. I think people want to see evidence that the issues of the past are behind them. And from here on, HDFC Bank is back on the growth trajectory. Otherwise, you would not get this bank at half the valuation that is historically traded over the last 20 years.
Okay, point well taken. We need to slip into a quick break, but just before I do that, Gautam, You mentioned this very important point about private banks versus PSU banks as well. PSU banks have had a rally, but we were doing some numbers. Despite the upticks that we've seen, some of them still trade at par on book, and their internals have significantly improved as well. So while there might be better value in private sector banks optically, are PSU banks an avoid, or selectively some of the PSU banks also offer value?
It's a broad statement, and I think you've got at one breath you've got a State Bank of India, which is as always traded at a different valuation than the rest of the PSU banks, and has a different level of respect, should I say, from the PSU banks. So, but at the same time, if you look at the number of stocks that are now in the top 100, you've seen a lot of other names come in there. Canara Bank, Punjab National Bank. So, in the top, if I look at the top 100 stocks in India, and that's the large cap definition by SEBI, you have a total of 21 PSUs, and not PSU banks, but 21 PSUs, which is remarkable. You always had the OMCs in there, you had ONGC in there, but now you're looking at so many more PSUs come in. So I think the overall sentiment clearly has improved for PSUs from an investor's perspective. And yes, you may still have some PSU banks that may be trading at sub 0.8 times, or definitely sub 1 times book. But again, it's very stock specific versus having a broad generalization.
The wind industry stocks are in focus. The Ministry of Power has decided to potentially bring back reverse bidding, as wind tariffs rose in the auctions gone by, and demand also was presumably low. If this confuses you, first let's get in Varsha Chandani, my colleague, to try and explain what is this development and how it could impact. Varsha, good morning.
Good morning, Niraj. So as you rightly said, first let us see why wind stocks are under pressure, or rather which wind energy stocks are under pressure. So if you see, Inox Wind is down 5%, Sanghvi Movers is down 7%, and KP Energy is down 5%. Now, according to some media reports, Ministry had decided to bring back reverse bidding as wind tariff rise in auctions. Now, Ministry has sent letters to agencies for the same. Now, this is on the back of undersubscription and high tariff discovery in recent wind bids. Just for an overview, there are two types of bidding. One is reverse and the other one is closed bidding. Now, under reverse auction, bidders continue to bid against each other after the initial bids are opened, until a bid tariff goes unchallenged by a counter bid. Now, incidentally, the ministry had given up this reverse auction at the beginning of this financial year. The method did bring down tariffs, but the problem was company had a lot of inventory that they sold the inventory at such a low prices, which led to poor capacity installation, which affected the wind industry as a whole. So with this, the reverse auction was given up and the closed bidding system was adopted. To which tariff did rose. But NDTV Profit did spoke to Inox Wind management in Q2 FY24, wherein he said that last time there was a problem as everyone had an excess inventory and sector was also not doing well. But now situation is different and government has target and company don't have excessive inventory. But so this shouldn't affect Inox Wind or any such wind company stocks. But let's see what happens.
Yeah, well, for now, the stocks have certainly gone down. So viewers, I hope you got a basic understanding. Now, Gautam, I would love to understand from you, I don't know if you looked at this space at all or no, but the company after company has come and said that OEM suppliers are not going to be supplying at losses, and this may not necessarily impact. But there's a change in policy and the stocks are down today. How do you look at the wind energy space growth per se over the course of the decade? And are these near-term impediments large enough, or will they be taken into stride?
Here's the way I see what's happened in the wind energy space. I think the government's focus, and at least until a few years ago, was largely on solar and making sure the solar manufacturers did well, succeeded in India, and that I think was going well. What I guess at some point dawned upon them was the fact that the solar generation happens only from around 8 o'clock in the morning till about 4:30 or 5 o'clock in the afternoon. So after that, solar power generation doesn't happen, and that was impacting the stability of the grid. So as a result, they went in for hybrid bidding and basically, I think most of the PSUs are now doing hybrid projects. when it comes to renewables. So it's not only solar, it's solar and wind. Starting from the 1st of April of last year, very clearly the government announced that they will auction as much as 10 gigawatts per annum of wind projects or 2.5 gigawatts every quarter. So I think that itself was a blessing for the wind energy industry. And as you said, this whole industry was actually in big trouble, both financially as well as in terms of the overall business. But a lot of balance sheets have been cleaned up. You've seen the stock prices of the two, and there are only two listed companies in this space, both Inox Wind as well as Suzlon. So you've seen a reversal of fortunes for both these companies and, of course, for the wind energy sector. Now, this new announcement, which just came over the weekend, the way I see it is if the government thinks the tariffs are too high and need to be lowered, and the fact that the reverse auction process will end up resulting in lower tariffs, frankly, I'm not so sure if that's necessarily a good thing. Because if you get some of the crazy competitive bidding that we saw pre-COVID or even 10 years ago, we don't need that to come back because these projects need to be profitable. And I'm not trying to put a number as to what that profit level should be or should not be. But yes, this does bring about a more transparent competitive bidding process. And if it does, and if the tariffs get driven down, I think that itself will correct on its own if the tariff structure gets so low that some of these companies may just not participate in the bidding. So I think the market itself should be self-correcting if the tariffs become too low. That's my personal view.
Got it. Okay. Okay. Let's see how the decisions move ahead. But the point you're making is absolutely well taken, Gautam. So thanks for sharing that. The other view that I want from you is what's happening to some of the other power-related themes, Gautam. I mean, one is renewable, of course, and the kind of capacities being set up. But we were talking to the coal secretary earlier today. He spoke about how the availability of coal is at 19 days, which is the highest that we've seen in a long time, and thermal capacities are being ramped up. What's your view on the conventional power space as well, which is trying to wade between the two, right? They are continuing the cash flows through conventional power projects, but at the same time also ramping up renewables. So have these stocks moved ahead of themselves, or is there potential for investments there?
No, I think some of these stocks have got multiple other levers than pure thermal generation. If you look at Tata Power, for example, okay, they've got a huge renewable business, which includes rooftop solar. It includes EV charging, setting up a whole nationwide network of EV charging stations. So, this is the conventional energy generation is not the only earnings driver anymore. And you're seeing other multiple businesses, newer businesses that are being sort of bolted on to the existing traditional power generation business. So I think that's what I suspect is driving these stocks more than pure thermal generation.
Got it. Okay. Gautam, earlier in the interview, when we started off, you mentioned about how a correction would be healthy. Maybe you are waiting for one as well. Who knows? But my question is, if that's the mindset with which you are currently sitting on Dalal Street, how are you going about choosing companies in which you deploy money? Is growth the panacea, or are valuations and low valuations the must-have starting point, or something else?
Yeah, good question. So we're actually a special situations fund. So the way we approach investing in the market is we look for stocks that we believe have triggers that will play out over the next 3 to 5 years. So I'll give you an example. We own a company called Eureka Forbes, a very interesting company wherein, again, full disclosure that we own it, but the fact is, very interesting company, wasn't that well run when it was under the umbrella of the Shapoorji Pallonji Group. Advent International came in and acquired 74% of that company. This is going to take a longer time to play out as they restructure the inner workings of the company. They launch more products, and they brought in Prateek Pota, the erstwhile, the former CEO, Jubilant Foodworks to come and run this company and turn it around. So I think a lot of positives going for it. So this is an example of the kind of turnarounds that we believe exist in companies. And valuation is one aspect of it, but the fact is what's not priced in from our perspective and what will play out over the next 3 to 5 years. So we are, like I said, more of a special sits. And if you focus on those opportunities, there are quite a few of them in India right now.
Gautam, I have a follow-up to this answer of yours and two questions out there. Since you mentioned special situations, what explains this arbitrage available between Inox Wind and Inox Wind Energy, since you mentioned that you look at that space? Because there is clearly a very large arbitrage there. Part one. Part two of my question, related but unrelated, you mentioned Eureka Forbes, a large block deal that happened. A lot of chatter around how foreign promoters are selling businesses and therefore why should people invest in them. Clearly, Eureka Forbes was in the buzz for that as well. Can you talk about that?
Sure. I think there is still an arbitrage left between the two Inox companies. And frankly, I think it's before the NCLT. So, until that happens, there are ways to play this and maybe get into Inox Wind at a cheaper valuation. So be it. But I think the runway of growth for the wind energy space in India is still very large, notwithstanding the reverse auction process that's just been announced. So I think I wouldn't worry about that. Specific to your second question was with respect to Eureka Forbes, right?
The selling, there's so much chatter around this that foreign promoter bech raha hai, so it's a bad news. But well, if you're invested, you don't see it that way.
Yeah, I'll tell you what it is. If you look at the last 6 to 7 years, the one phenomenon that we've noticed, and I've gone on media and said it as well, is the fact that global private equity funds are coming and buying out promoter stakes in listed mid and small cap companies, but keeping the companies listed. And the objective of keeping that company listed is because as and when they need to sell a chunk, they can do so. Now, there could be various reasons to sell a small block or a big block, depending on when they've come in and when they've invested in the company. One could be the fact that they've made a significant amount of money in the stock from the time they got into the company. So that's one. Two, there could be limitations with respect to the life cycle of the fund from which the initial investment came in. That doesn't mean they can't roll it into the next fund that they have raised. But there are multiple reasons. I don't know specific to why Advent did sell a block, but I suspect these are some of the reasons that private equity funds end up using the fact that these companies are listed and use that as windows of selling down blocks. Well, the third element, of course, which I would say is increasing the free float, because specific to Eureka Forbes, Advent International owned as much as 74% of the company.
Okay, fair call. Gautam, lovely talking to you. Thanks so much for taking the time out and being with us today, giving us your thoughts. Completely out of time here. But that's the view from Gautam Trivedi of Nepean Capital. And viewers, thanks for tuning into this edition of The Talking Point.